Okay, good afternoon. Today's March 25, 2022. This is your weekly take on the market. I will be your host. My name is Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily. Here is the disclaimer. Please take a moment to read it. We are not licensed at Investors Business Daily. I'm not. Nobody is that works there. So take a moment to read the disclaimer. Okay, so I had some technical difficulties. This is my third go round with this take on the market, so bear with me if I try to cut this short. So we'll go through the markets, the industry groups, stocks to watch, and then we'll do the quote of the week, obviously. All right, so let's go to the NASDAQ. And here's a chart of the NASDAQ. You've got the wave down, try to rally a little bit, another wave down, bigger rally, third wave down. You get a follow through day there, and now you're in an uptrend and the market's kind of shaking off bad news, one down day, one down day, one down day. And hopefully you notice that this doesn't quite look like the NASDAQ, right? And that's because it's the NASDAQ from October 30th of 1998. And this market reminds me a little bit of that time period. So let me fast forward one more month. And you just see how it just kind of left everybody in the dust on the way up. Just grinding higher, a couple of down days, and you just can't seem to get in. Like there's no consolidation that gives you a chance to get in. Here's your first pullback to the 10-day right there. If I advance another month, this is your first pullback to the 21-day, which is December 14th, 1998. The follow through day, I believe, was October 14th, 1998. So 2 months of uptrend, steady uptrend before you have any type of pullback to even the 21-day. And I think I did the math on that as about 33% rally from the follow through day to that point. So just huge move. And there was a lot of bad news in this time period. Yeah, this was the Asian financial crisis that kind of caused this, excuse me, this whole meltdown. Long-term capital, the Fed had to come to the rescue. What seems like peanuts nowadays compared to, back then, the billions they were going to throw at it seemed like a lot of money, unfortunately. But it just grinded higher, and I remember it very clearly, like kind of being on the outside looking in, looking for the right time to buy it. And we'd been in a bull market for a long time. This is the 87 crash. This is the 1990 bull market. The United Airlines leveraged buyout, I think, failed, and that caused a quick meltdown in the markets. I got into the market. Well, I started in the market, I think, right in here somewhere in 1994, April, somewhere in there. I feel like, I guess I can't remember exactly when I started as a stockbroker, but it was somewhere in late 93, early 94. I do remember I finally had enough money to open my own brokerage account in March of 95, which is right there. So I was in the markets, but I had no personal money. And so I opened my first account right there, and it was just straight up. The markets were great the whole time. You go from 800 to 2000, 2.5 fold move. And so it seemed likely that you could have a bear market here in this environment, and all the the news was set up for it. There was, there's some bad news, but the market kind of left everybody in the dust and just kept rallying. So let's go to the current market, and that's a little bit, so far it's early in that, but it feels like that a little bit to me. Like today, the market with 20 minutes to go, it didn't look like it was going to be a very good close. And then they jammed it, in the last 20 minutes, put on like 100 NASDAQs. And it's probably option related, so be it. I'm not really worried about that. The bottom line is they came in and bought the market. And it feels like a lot of people are on the outside looking in. And so that's why the market just kind of grinds higher. You know, I know there was a lot of 1% days up in a row, which was unusual. The number of instances in stock market history is very low, but the instances where you had that kind of breadth thrust are usually fairly positive going forward. So I think the jury's still out. If the market makes a new high, I'm telling you, I will not be surprised. If it makes a new low, I don't think I'll be that surprised either. I think it's like, I'm probably like 60-40 that 60 that it goes to new highs before it goes to new lows. Not a very good, it's almost a coin flip, but I don't have to guess. I do I have some longs, and then I have I'm short an index, and I'll kind of let the market either pull me in more long or take me out of my longs and pull me in more short. I don't think I'll add that much to the short because I don't like to press shorts to the downside because I've talked about it. You just get killed. You just get run in when you press shorts. I might put on some other shorts, some newer names where they might be more timely. But I'm just going to let the market do that. And I just don't think right here, it's not a high conviction environment. I wouldn't be 100% invested in a cash account. I wouldn't be 100% short in a margin account. I wouldn't have any kind of that type of conviction here. I just don't think there's enough information right here. This could be a bear market rally, but the longer it stays up here, the more likely it isn't, right? Bear market rallies are short, vicious. They go up a lot percentage-wise, but usually swift. They usually end pretty quickly. So we'll have to see. But if we can get above like these highs and then above this moving average, we get into here and start living in there, then I just don't think it. I think the bear market is over, possibly. A lot of names have had a bear market, a nasty bear market. And we could sit here all day with Shopify and PayPal and Square and just go on and on. And the growth area is still very weak. Some of these stocks, like some of the favorites like Roku and PayPal, and they might not come back. They might not come back. There might be new leadership, as crazy as that sounds, right? And you can see Shopify had, a couple of really strong days, but then so far it's just not really doing a whole lot. I don't know. Some of them will come back, but based on history, a lot of them won't. So you'll want to kind of wait for the new leadership. The S&P, and I think I heard we're 6% off of all-time highs, and I think this rally might have been like 5 or 6% too. And so you have to think, gosh, they have thrown everything they can at the S&P. The war in Ukraine, the Fed's going to raise interest rates 8 times this year. Powell comes out and says, we got to do 50 basis points next meeting. Inflation is a problem. What else is there? The bond market is, part of the Fed problem. The bond market looks terrible. 17% on the TLT that's a big move. That's a really big move down. So it's just gotten torched. Corporate bonds, high yield, or LQD is more. It's a better proxy because it's not more speculative ones. But HYG, I think, was something that the Fed was supporting, that they were buying in the COVID crisis. But look, LQD is down 12%. If you've seen it, we don't have a chart of mortgage rates, but if you have a mortgage or are thinking about a mortgage, what is that $TNX? I can't remember the reverse, but basically mortgage rates look like this, just straight up. a lot off the lows, and they were historical lows. You can get like a 15-year for I think 2% or something like that. It's just giving the money away. And so there's a lot, they've thrown a lot at this market, and the bull case will be the market's held up really, really well with all that bad news. And I think there's a lot to be said for that. Like, I think the market does a very good job of taking the information it gets and discounting it fairly quickly. It's not perfect, but it does a pretty good job. And if I know about it, if it's all over Twitter, then it's in the market to me. And, the big money knows, the big money sees that they know the bond market's acting awful, right? So why are they buying stocks? I don't know, but you have to give that a little bit of weight if you're bearish. We can take the other side of the coin and say, well, the market, there's so much bad news here, and the market's only down 6%. There's a lot of room for it to go down. I don't give that theory as much weight, but that's not impossible. That at some point the market like wakes up, like it's whistling past the graveyard, and it wakes up and says, whoa, there's all these problems in the world, let's go down. It could happen too. So you have to be flexible to all the options. The good news is you don't have to make a bet and an all or none bet. I think you want to be nimble here, and you probably want to have some longs in case this just keeps going up. And if you like to have shorts as a hedge, or you just then maybe you can. If you don't like to short, no problem. Then you probably want to be partially invested. Now, depending on your aggressiveness, and maybe that's 30, maybe that's 50, maybe that's 70. I don't know. The right answer is different for everybody. I know on IBD Live, David Saito Chung will often ask everybody how much they're invested, and they're all different numbers, and everybody is getting the same information, right? David Ryan, Chris Kessler, we all see the same thing. So why are we all different percentage invested, right? Because it comes down to personality and risk tolerance and things like that. So we'll know eventually what happens, but right now we're kind of in no man's land is the best way to put it. All right, let's for the sake of brevity, let's no, I don't want to jump to quote of the week just yet, but let's go to the industry group. Sorry, that's what I meant to do. Industry groups, coal, international, oil and gas exploration, Canadian, chemical ag, oil and gas drilling, mining metal ores. You get the idea. It's all the same. Nothing's really changed in the industry groups. One thing I like to do each weekend is I'll go through this tab here 3 months ago. I'll just eyeball and say, is there anything that's moved right to left in lower sequential numbers? So it's not perfect, excuse me, but metal distributor 180, 22, 20. Now there are only 3 stocks, but I really like to see mining metal ores 151, 35, 20, 12. How do you find the breakout before the group becomes number one? I don't know if mining metal ores is going to become number one, but if it were to, it'd be too late, right? All the names will have broken out. So when it went from 151 to 120 to 110 to 90 to 70, and if you're doing this work, at some point it'll come across and say, whoa, I need to explore this group. And you go in there and you look for setups, and then you might find FCX, which is a name that I'm in, or you might find Rio, which is a name that I was in. I just decided that I didn't need FCX and Rio. So then you're ready for when the breakouts come. Valier is how you pronounce it. I always call it Vail because that's with the ticker. But you get the idea that you're ready for these by going through those industry groups. And I might go through 2 or 3 industry groups a week. Next week, if I see mining metal ores, I don't need to do that. I already know what stocks I'm going to buy. I've already looked at that group. So I'm just looking for a group that jumps out at me, that's new, that's different, that I'm unaware of, and has a few stocks in there. If it's media periodicals, 3 stocks, not interested. Metal product distributor, I might go there and let's open up the related information panel. I'm curious what stocks they are. So it's Norsk, RYI, Zeus, unlikely. RYI, I've missed the breakout already, pretty small. Zeus, well, see, I missed the breakout. I see what I mean? So you have to be on top of it. Like if I was interested in Ryerson, I needed to be interested there. I needed to be ready in March. And if you're doing that work, you would be. It's unlikely I would have bought that stock, but at least I'd have been ready for that to see it. Stocks to watch. I think the energy is the place to be, which is why the S&P, even though it has such a small weighting, is holding up so much better than the NASDAQ, because NASDAQ has no weighting there. But like EQT, for example, very extended. I don't own this one, unfortunately, but it's very extended. Now, it's only 4 weeks out of the base, so you have to decide, am I going to try to give this more room? I wouldn't be a buyer here. I wouldn't be adding to it. If I owned it, I'd be selling or reducing for sure. But if you're more of a long-term holder, then you need to be willing to understand that there could be some kind of pullback coming. Tidewater, very extended. Now these aren't climax tops because they're so soon coming out of bases. If we go back to EQT, it's only 4 weeks. Now, let's say it did this up here and then did that. Well, that would probably qualify more as a climax top. So it'll come to my quote of the week. You really have to understand, what's my position size? What type of trader am I? Am I going to hold this? Am I going to be able to stand the ultimate pullbacks and then proceed accordingly? But there's a lot of really good action in this group. Devon's been a really good one. Here's one that I was in there, and it just kind of wore me out in this base. And now it's a double from there. So there's CVE. Is that wasn't, what was that? There was another one today. Oh, SBO, very thin, but really good breakout. So they're just everywhere. Liquefied carriers, GLNG, FLNG broke out this week. I do own this one, FLNG. So they're out there. There's stuff to own. GNK, another shipper, broke out of a base. Different than those. It's dry bulk versus liquefied natural gas, but acting really, really good. So there's stuff that you can buy. Now, Zim is dry bulk, and it's gone on a huge run already and looks a little bit like it's reached at least a short-term climactic top. Upper channel line there, maybe that one breaking above the channel. Massive dividend. And I wanted to bring this one up because a lot of stuff on Twitter I saw about the dividend and the fact that we adjust the chart. If I go back on this chart, before they do the dividend, March 18th, stock's 84.5. March 21st, the stock's 88. March 22nd, the stock is 77, but up for the day. How can that be? Right. So we're adjusting it for the $17 or the 24% dividend that they issued. And the reason we do this is if we didn't, there'd be a huge gap on the chart. Like the stock would have a $17 move down, because if you owned it, what happened, right? It was down in your account, looked like you had a big hole in your account, but then a few days later, the dividend fills that hole in. So when it's a special dividend, when it's unusually large, like Zim has had a few of those, we want to adjust the chart for those dividends. So it's more continuous. The charts, otherwise there's gonna be a gap here, gonna be a gap here, gonna be a huge gap down here. and it's just not going to look as clean, the chart, because it'll look like a stock that gaps down all the time. Well, it's not really gapping down. It's just different in the excuse me, the way that you're getting paid. So that's why we do that. And a lot of people emailed us and it's on Twitter about it. And we've been doing it this way for a million years. If it's a normal dividend, Blackstone or something, we're not going to adjust the chart. So if you go, oops, what happened to the, oh, I'm on the wrong date. That's why. So, normally it's a high yielder, but it's a normal dividend. If there's some consistency to the dividend, then we're not going to adjust the chart. Apple, we're not going to adjust Apple's chart every time it pays, its dividend. So keep that in mind. As far as, what happened with Zim, and going forward, you'll know that if XYZ does that, we're going to adjust the chart accordingly. Okay. And is there anything else I want to talk about? Well, I guess there is in growth stocks, there's 3 stocks that are trying to lead a little bit: AOSL, ACLS, which I own, and today was tough to own, but I think at one point it's down 5. And GFS, is that Global Foundries, which I own, and they're trying to take the lead. These are newer names. NVIDIA looks really strong. Hard to argue with that. Apple, I just pulled that up. Gosh, blue dot, double bottom. Look at that. The RS line is a new high ground. The Apple is just crazy strong. But so there is stuff to own, but you really have to make sure that you're positioned accordingly. So today I did the math on ACLS, and take it for what it's worth. I didn't fact double or triple check my work, but I had a pretty good sized position in the stock, and went from 80 to 76.70 here, and then it rallied from 76.70 to 82.71. And then from 82.71 down to 79.72, and then 79.72 to 82.89, and on and on and on. And I calculated like 1, 2, 3, 4, 5, 6, 7 of these kind of stops and starts here, all of those. And this week alone, the stock moved 32 points. 32 points I had to mentally, the highs and lows. It was great when it was on the way up, and it was like, whoa, on the way down. Great when it was on the way up, and then today, whoa, on the way down. So it's an $80 stock. And if you look at the chart, it doesn't look like it's not done anything wrong, right? So you have to understand what you own and how they trade, the personality of these stocks, and yourself. So that it reminded me of this quote, this action in ACLS. And I tried to find out who the quote is attributed to, but I couldn't find it on the internet. Anyways, there really are only 2 positions in the market. There's just too much or not enough. So when it's going down, I had too much ACLS. And yesterday when it was going up, I didn't have enough. And you have to fight those emotions all day long with stocks you're in. Because I fight, that's like the biggest thing for me, is like when it's going good, when the stock's going good, I want more of that stock. And when it's going bad, it's like, even if I have 100 shares, it's like, that's 100 shares I don't want. And it's not, you can't be that perfect with it. So you have to give it some leeway. So this is a great quote to think about your position size. You'll always never have enough if it's going good, and you'll always have too much if it's going bad. But you should have some type of rule or standard for your position size. That way, if it's going good and you have this desire to put more on, you can say, I have this rule. I'm capped at X amount. I'm already capped in ACLS, Scott. I know you want to buy more, but you're capped, and don't buy more, and just allow it to go up. And if it goes up, great. You have X amount percentage. And vice versa, on the way down, I usually like to have a standard minimum position. Like, I want to keep this stock. It's not acting good, but it's just the short term, I believe. Like if I were to go to FCX is a perfect example. So here in the morning, the stock was 51 and change the next morning on this day right there. Actually, in the morning was indicated higher, and I actually sold some at 51 and change before the market opened. And then it went from 50 down to 43. And the whole way down, it's like I knew I had too much, which is why I wanted to sell some at 51. And then on the way to 43, I still had too much. So I was selling at 48 and 45. And so I really should have known what's the right amount. And once it started to come in, and let it come in, what's a typical place it could come into? The 50-day, perfectly typical. So I have to know that it could do that. And what's the right amount holding to that potential target downside, and then just leave it alone. And then if it starts to bounce up, I can add to, what I wanted to for a stock that's more in an uptrend, but don't add too much, because if I get over my skis, then, I'm going to be puking. So instead of selling at 51, I'm selling at, 44. It's a big difference. So you have to know where your standard position sizes are, and where, what an aggressive position size is, and what a lower level, like just, this is the bare minimum position size. You probably don't want to go below, like, I don't know. For me, I don't think I would ever have anything less than 1%. That'd be really, really low. I usually try to, if I have something I like, but I think it can come in, I usually try to cap it at a 5% position. Like, that's going to be my 5% position. Hold it. If it goes down 10%, I lose 0.5% on the whole portfolio. If it's a 5% position, I ought to be able to withstand that. And that, I mean, that 10%, off of the highs, usually that would be 10% of profits given back, or some potential. Maybe I'm up 7% and I go from up 7 to down 3. That would be a minus 0.5% on the whole portfolio. Now, it's not in a vacuum, because, when FCX does that, 8 other stocks you do that. So if I go down 0.5% on 8 other stocks, I'm going to go down 4% off the high, right? So you need to build that in your model. And how much am I up for the year? If I'm up 12, 16, 20% for the year, to go back 4% is nothing. I ought to be able to do that. If that happens, doesn't mean it's going to happen, but I need to understand that could possibly happen. So I think position size is so important. Most people don't spend enough time thinking about it, because there is no standard. There's like this. There's no perfect number for everybody, because we all have different risk tolerance, different lots in life. I've mentioned it before, how old you are, how much runway you have. You can be more aggressive. I can't start over now at 25 years old. I used to be fully margined all the time, over the top margin. And I didn't think about, like, oh, if I blow up, I can start over. But in hindsight, I just was more aggressive and had a lot of potential runway. And that's the best time to learn. Like Jim Rogers says, the best time to go broke is when you're young and have no money. So, because that's the way to learn. So but as you get further and further into this game, you just can't do that. You can't risk that. So you have to risk a little bit less. So everybody just think about your position sizing. That's the moral of this quote. And I think it'll serve you super well going forward. Next week, no take on the market. It is Good Friday. The markets are closed. We'll do the Thursday stay in step the day before. All right. Contact information, reach us at marcussmith.com, 800-831-2525. Thanks a lot, everybody. Have a great week. Bye-bye.